We're getting very close to the end of this course. We're talking about classified financial statements, page 177 to 181 of your textbook. So today we're going to talk about preparing classified balance sheets, talking about current and fixed assets, as well as current and long-term liabilities. We're going to talk about assets and how we put them on the balance sheet. We're also going to learn how to make a supporting schedule for the owner's equity and the schedule of accounts receivable. And we've already talked a little bit about liquidity, and we'll touch a little bit on the cost principle as well again. Okay, so the balance sheet of Physio Central is a classified balance sheet that includes some of the standard classifications. In this example, the assets are divided into two main groups. We're going to talk about the current and fixed assets. The liabilities are divided into two groups, the current and the long-term. Current assets are cash and other assets that will be converted into cash or sold or consumed in the ordinary course of business, usually within 1 year. So if it's a current asset, it's something that could be used or sold in 1 year. The list on the next page provides some examples, and we'll talk about that. I think that's my next slide here. So here are some types of current assets. We have cash, we have government bonds, marketable securities, accounts receivable, supplies, and prepaid expenses. For accounting 10, these are the four that we talk about. We haven't really talked much about prepaid expenses yet. These are payments made in advance. They are items such as prepaid insurance and prepaid rent. They represent the value of the unused portions of insurance policies. So if your company can buy a whole year's worth of expenses of insurance, and as they use them, the cost or the value of that insurance goes down. So anything that you don't use or haven't used yet, you can actually convert it into cash. That's why it's going underneath the current assets. Fixed assets are assets such as land, buildings, equipment, trucks, and furniture that are used in operating the business and have a long life, in excess of 1 year. Here are some types: land, building, equipment and machinery, delivery trucks, and furniture. Fixed assets are recorded using the price at which they were purchased. This is called the cost principle. This is a standard principle used by all accountants of companies that use the ASPES. Those are the standard policies. Fixed assets may be recorded using the fair value principle or the cost principle as well. Current liabilities are generally refers to liabilities that must be paid within a year or less. Accounts payable, taxes payable, salaries payable, loans payable. Long-term liabilities are not due to be paid for more than 1 year. So that would be like your mortgage, a loan. Okay, and then we want to talk a little bit, we actually have already talked about this in previous sections, but just as a review for owner's equity, this is what your owner's equity section would look like now on your balance sheet. This is what you're starting with for your capital at the beginning of the month. Now this company had a loss, and they took out drawings. This is the total of these two here. And then to get your final capital, you would subtract those two because those amounts are both being taken off. Okay, sometimes your company will have a net income. So this is what you're starting with. You have a net income. You took a drawing of $1,800. You need to subtract these two to come up with, and it's a decrease because you took out more than you made, and therefore your total balance of your capital would be that value there. Okay, and supporting statements and schedules. In addition to the income statement and balance sheet, a number of additional statements or schedules may be used to provide financial information. And I'll show you on this next page here. This is what the statement of an owner's equity is. So it can be a form that you would do at the end of every month, is prepare this. It also is put on the balance sheet, but some companies like to have its own statement like this. Okay, and as you can see down here, This is your owner's equity section right there. Okay, so as you can see, you have your current assets listed here. You have your fixed assets listed here, your current liabilities, your long-term liabilities, and your owner's equity. And they didn't list everything that they listed back on here because this company is going to provide a statement of owner's equity in addition to the balance sheet. Okay? And you see how now they know exactly what their assets are, how many are current, how many are fixed, and same with their liabilities. So it provides just a little more detail. Here is a schedule of accounts receivable. This is really important for a business to know exactly who owes them money. So what they do is they make their own statement or schedule. And it basically is just a list of all their customers who owe them money. And I'll flip back here. I'm not sure if this is the same one. Yeah, it is. You can see here accounts receivable 2600. So they didn't list everybody's name on the balance sheet. Rather, what they did is they made another schedule here. So they had to go back to look exactly who owed them. They could easily find out. Okay, and this is just a summary of what we've already talked about here as well. Okay, so we're going to practice making those schedules as well as a new balance sheet.